Do you constantly change your strategy? And if you do, is the first thing you think about the entry? If so, this video will be perfect for you. Welcome to Squirrel On Charts, your resource for advanced trading education. Let me give you 3 steps for creating a trading strategy that fits your unique style of trading. Let's jump right into step number 1. This step sets the foundation of your strategy. Before thinking about the entry, you must think about what it is that you want to trade. What is the goal of the strategy? There are many different things you could trade, and each of them needs a different approach and different trade management. Let's look at the 2 pictures below. On the left-hand picture, you can see a single market move without any deeper pullbacks. On the right-hand picture, you can see a bullish trend that consists of strong moves in the trend direction as well as deep pullbacks. You can probably imagine that you would trade both things very differently. Let me show you 2 additional examples. Below you yet again see 2 pictures. On the left-hand side you can see a sideways market. On the right-hand side is a trend reversal. As you can see, there are many different things you could trade. I've shown you single market moves, trends, sideways markets, and trend reversals. Of course, there are even more. Another thing many traders like to trade are breakouts. You can hopefully understand why it is so important that you know what you want to trade with your strategy before creating the rest of it. For some, it might seem obvious that you don't trade sideways markets with the same approach that you would use for trading the trend. But many traders mix those goals up. Someone might create a strategy for trading the trend, but he then closes his trade before the market makes a pullback, because he is scared of keeping the trade open during a pullback. The trader therefore ends up trading a single market move, or maybe just a breakout, instead of the complete trend. Alright, time for step number 2. Now that you know what you want to trade with your strategy, it is time for building a trade management plan. You should already know what you want the market to do after entering the market. For example, breaking out of something, staying in a sideways market, or continuing the trend. So, this concept is all about how you manage the trade, in order to cut losses and let good trades run. Therefore, this step includes your initial stop loss and take profit. But also what you want to do after the entry. For example, do you want to use a trailing stop loss? Or, maybe you want to limit risk and increase profits by doing partial closes. It's important to note that this step does not include your entry. Most traders like to think about the entry first. But in general, it makes more sense to first be aware of how you manage the trade, and later on you choose an entry point that fits your trade management plan. Let's look at the left-hand picture. This is a good-looking bearish trend. Again, let's not talk about the entry yet. Instead, let's think about what type of management we would need for a trade like this. In the case of trading the trend, you might want to place your initial stop loss at the extreme of the last pullback. Maybe you don't want to use a take profit, and instead use a trailing stop loss that you always move to the extreme of the last pullback. Additionally, you could take partial profits after the market went in the trend direction for some time. On the right-hand picture is an example of a single market move. A good option might be to have a much closer initial stop loss. And instead of keeping your stop loss at the extreme of the last pullback, you might want to trail your stop close to the market. Because remember, you want to trade the single market move, not the trend. In other words, you want to get stopped out when the market starts a deep pullback. What would a trade management plan look like for a breakout trade? For breakout trading, you need a very tight stop. Either the market makes the breakout or not. And if the breakout does not work, you should close the trade, with the option of trying again later. Next, you might want to think about how you can increase your profits when trading a breakout. You could take partial closes fairly soon after the breakout. Then you could keep the trade open while trailing the stop loss very close to the market. On the right-hand picture you can see a trend reversal. By now you should understand the process of creating a trade management plan. But again, where would you place your initial stop loss? Would you use a fixed take profit or just a trailing stop loss? Does it make sense for you to take partial profits? Or maybe you even take partial losses when the market doesn't reverse as expected. Make sure to ask yourself these questions when creating your trading strategy. Finally, we get to the third step, your entry. Of course, there are many options for your entry. You could simply enter the market, or use an indicator, or price action patterns, and so on. But no matter the exact method, there are some things you must consider. First, your entry must fit into your trade management plan. Your trade management plan from step 2 has defined your stop loss and take profit, as well as your approach to limiting risk and increasing profits. Now you must choose a reasonable entry, based on your desired risk-reward ratio, as well as signal confirmation. Because you already know your stop loss, you can easily calculate the risk-reward ratio for different entry places. When trading a low-probability trade, such as a trend reversal, you need a better risk-reward ratio to offset the lower probability. When trading in the direction of the trend, you might be okay with a slightly worse risk-reward ratio, because you have the probability on your side. Next, you have to decide on what type of signal confirmation you want to use before taking the entry. I've made a complete video about this. I'm going to place a link in the video description. Especially when trading sideways markets, you need signal confirmation in order not to enter at the moment the market breaks out of the sideways zone. Let's look at some examples. On the left-hand picture we have the classic trend trade. When trading the trend, a common entry is at the high or low of the pullback, depending on whether you trade a bullish or bearish trend. On the right-hand side is another trend. This one has fairly small pullbacks. You can use indicators, such as the moving average, as your entry for almost all types of trading. Next, we have a trend reversal on the left-hand picture. When trading a reversal, I would always wait for the current trend to get broken, as shown by the black line in the picture. After the market broke the bearish trend by creating a higher high, the market soon after started a new bullish trend. You could enter into the new trend either as soon as the market makes a new high in the trend, or simply base your entry on an indicator or price action pattern. On the right-hand picture I've one last example. This is for sideways markets. A reasonable place for your entry is always the outer zone of the sideways market. I know, this was a ton of information. So let's summarize. Step number 1 is defining what it is that you want to trade. In step number 2, you create a plan for managing your trade. This includes tactics for limiting the risk and increasing the profit, such as your stop loss, take profit, trailing stops, partial closes, and so on. In the third step, you deal with the entry. Your entry must fit your plan from step 2. Furthermore, your entry must allow for a reasonable risk-reward ratio and should consider some form of signal confirmation. Alright, that's it for today. If you have gained some valuable information, feel free to subscribe. Thank you for watching and good luck on your journey. Bye.